Welcome back, guys. If you are new here, my name is John, and this is Talk Finance. And today we are talking about a well-known REIT called Medical Properties Trust, ticker symbol MPW, that currently pays a pretty high dividend, coming in at 11%. Is this a company I would consider a buy right now with a great dividend yield, or is it a dividend trap? Let's look at some details about Medical Properties Trust to get more information on whether this would be a good REIT to purchase in your portfolio. And feel free to let me know how you feel about Medical Properties Trust. Is this a REIT you currently hold in your portfolio? I do want to let you all know that currently I do not hold any shares of MPW. Okay, let's get started with the current share price, which as of close Friday sits at $10.55 a share. It has a 52-week low of $9.67 and a 52-week high of $21.63 a share. But what does Medical Properties Trust do? According to their website, they understand healthcare. It reads, "We understand hospital needs, and we have the capital resources to help. MPT is a financial partner that offers more resources, more capability, and more ways for the operators and investors to seize financial opportunities." In other words, they invest and purchase healthcare facilities and lease them back as triple net leases to its tenants. They are the second largest non-governmental owner of hospitals in the world, experienced in unlocking the value of hospital real estate for growth, and preferred by top operators around the globe. The mix of portfolio locations include United States and United Kingdom as their largest investment locations by a combined 82%. A few other locations include Australia, Switzerland, and Germany. The combined asset value for all properties is $20 billion. Their compound annual growth since 2012 is 125%. They have been paying a dividend almost consistently every quarter since 2005. But although they have quickly increased their dividends early on to as much as 27 cents a quarter, they just as quickly dropped it in 2009 to 20 cents a quarter and kept it that way until 2014, when they started increasing their dividends consistently again to what they are now, which is 29 cents a share, paid out every quarter. That's great that the company was able to adapt and keep their dividend going, but there's a lot of other REITs out there that have been paying just as long and haven't had to adjust their dividend payment. If anything, some other REITs have been able to increase their dividends even in a similar market condition. We all know the healthcare industry is growing, and Medical Properties Trust is a leader in this industry. But when I look at it as an investment, well, I would buy a different REIT. Don't get me wrong, Medical Properties Trust isn't going anywhere. They currently have 444 properties, 44,000 beds in 31 states and 10 countries. And like I said before, an asset value of $20 billion. But as this article from the Motley Fool explains, the company posted a net loss of $140 million, or 24 cents per diluted share. The loss stemmed in large part from an impairment of $171 million related to 4 Pennsylvania properties leased to Prospect Medical Holdings. In addition, Medical Properties Trust wrote off around $112 million in rent to Prospect. Second, the healthcare REIT provided weak guidance for full year 2023. Medical Properties Trust expects earnings will be between 83 cents and 98 cents a share. By comparison, the company posted earnings of $1.50 per share for full year 2022. It also projects normalized funds from the operations of between $1.50 to $1.60 per share. Normalized funds from operations for last year were $1.82. But they listed good news for MPW as well. They said that a bright spot is that there's increasing optimism in general for the hospital operators who lease properties from the REIT. Aldag stated in the Q4 update that the outlook for improving margins across the hospital industry looks brighter this year. They go on to say that Prospect is making headway with its plan to divest operations in Connecticut and Rhode Island, with deals expected to close later this year. The hospital operator's managed care business has been valued at close to $1 billion and should be attractive to potential acquirers. The progress has led Medical Properties Trust to fully exit all of its investments in Prospect outside of California and reinvest the proceeds. So as you can see, they definitely have plans to improve their profit margins in the near future, but is the company right for your portfolio? If we go look at their share price appreciation, we can see that, well, they have none. Since the company went public in 2005, it is down over 4%. If you would have invested 5 years ago, you would also be down by 19%. I will say in June of 2022, they were at their all-time high, and there's a chance they will get there again since they did just have a recent sell-off. If you want a company that will pay you a consistent quarterly raising dividend, then this company could be right for you if you plan to hold them for a long time. They have a business that, at their size and with the type of buildings they purchase, doesn't have as much competition. But their share price does not show any appreciation such as other REITs. And yes, I know, REITs don't tend to have high price appreciations, but they should increase over time as the REIT becomes larger. If anything else, show us some stable, consistent dividends, even if the growth isn't fast. Investors that purchase a dividend paying company might not always be looking for the dividend to grow, since they might be looking at share price growth, but REIT investors want to see long term dividend stability and the idea that you could sell your REIT in the future for at least the same value that you purchased it at. I like the potential that Medical Properties Trust offers its investors. I mean, they did just have a sell off and a substantial drop just this past 6 months. And analysts are predicting that their share price could go as high as $18, but I won't be buying them. Like I said, they definitely have potential and aren't going anywhere. But there is other REITs that I would rather purchase at the moment, and other qualified dividend paying companies as well. If you found this review helpful, feel free to subscribe to the channel, and while you're at it, give the channel a like. I would greatly appreciate it, and you will be helping out the channel. See you on the next one.